Andy, everybody's arguing about the upside. I want to flip it. I mean, could you sit down and make a rational argument for $65 a barrel oil?
Well, we can, and the number one item on that would be a recession that triggers a significant amount of demand destruction, and that would start off at Europe, who are being squeezed with high electricity and natural gas prices, and as a result, we're seeing industrial production slow down in the fertilizer business, aluminum, zinc, steel, cement, and glass. And as that spreads around the world and you get demand destruction, you could see prices plummet like they did in 2008 to 2009 to $35 a barrel, or in 2014 to 2015 where we dropped to $45 a barrel. So there is a case to be made for lower oil prices.
Is it a good case? I mean,
well,
do you buy the case you just made?
Well, I don't buy the case that it's going down to those levels. And in fact, as world oil demand continues to grow, we see more difficulty on the supply side of the equation, which keeps these numbers relatively high. I think that WTI, when I look at the forward strip, you really need $90 a barrel to encourage continued drilling around the world. The fact of the matter is that the SPR releases are going to end in the middle of October. We've yet to see the full impact of the EU phased-in ban on Russian supplies, which takes effect December 5th for crude oil and February 5th for refined products. And we think about Libya, their supplies can come and go on a week-to-week basis of up to 1 million barrels a day. So it's the supply side that's the big issue.
Yeah, and I was reading a note last night from Raymond James, Ed Mills, very excellent note talking about the risks of retaliation, what it might mean, what Russia may do. Also the talk about the relationships between India and China and where this all plays out. Price caps, will they work? Who knows? I mean, gosh, there's so much going on, Andy, between now and December 5th. I don't know if anybody really knows what's going to happen.
Well, I think that's right, but certainly India and China are benefiting from the discounted Russian oil, which is selling at roughly $24 a barrel below Brent. So, of course, they don't really want to participate in the price cap because they're already benefiting. I think the biggest issue as I see it going forward is what happens to that Russian diesel that was going into Europe. That's about 700,000 to 900,000 barrels a day. And the most likely outlet for that is Argentina and Brazil, who are both seeking deeply discounted diesel fuel. Between Mexico, Argentina, Brazil, and Chile, they're buying about 700,000 barrels a day of diesel fuel from the Gulf. If they replace that with Russian oil, our diesel fuel off the Gulf Coast is going to backfill into the European Union. And actually, that mitigates any supply disruption.
Shepard Smith here. Thanks for watching CNBC on YouTube.